who are going to give the presentation today. Just as a brief introduction, Ballard Spahr is a national firm with more than 600 attorneys and 15 offices with expertise in business and transactions, finance, IP, litigation, and real estate law. I really appreciate Jacey, Kate, and Chris being here to present today. I'm going to do quick introductions, and then they have a presentation they'll give, and then there'll be time for Q&A at the end. Feel free to put questions as you think of them in the chat. And as Pearl mentioned, we will be recording the presentation. So welcome. Chris Jones co-leads the firm's tax team and advises clients on a wide range of federal, state, and local matters. He regularly counsels nonprofit organizations on a wide range of issues, including formation, federal and state compliance, unrelated business, taxable income, and joint ventures. He co-leads the firm's exempt organizations team and has represented nonprofit organizations on IRS exempt status, employment, and information reporting audits. Kate Belinski, who's also joining us from Ballard Spahr, practices political and election law with a focus on lobbying and public policy, campaign finance, government ethics, and matters involving administrative law. Her clients include corporations, trade associations, other nonprofit or organizations, advocacy groups, as well as PACs, super PACs, and other political committees, candidates, and office holders. She also counsels numerous members of Congress and their staffs on legal and financial disclosure obligations under the Ethics in Government Act, which I'm sure is interesting, if not painful at times. And then a special thanks to my friend and former colleague, Jacey Skinner, who's held a wide range of senior leadership roles in Utah state government and Utah business organizations. Before joining Ballard Spahr, she served as general counsel to Governor Gary Herbert, and she also has extensive experience in policy development and advocacy and has represented numerous nonprofits working at the intersection of public policy and economic development. So thank you all for being here. And for sharing with us your expertise and helping to inform our coalitions. Pearl's going to pull up the slides, and I'll hand it over to the three of you.
All right, great. Well, thank you very much for inviting us to be here today. This is basically what Chris and I do is counsel or groups on forming nonprofit organizations, governance, and just kind of the rules of the road and figuring out the best vehicle and the best way to be able to move forward to kind of legally, efficiently, and compliantly, carry out your activities. So if you want to go to the next slide, please. I just need to give this little disclaimer here at the beginning, since we are not actually providing, you're not our client, we're not providing legal guidance. This is just general information that we're providing. Just so that we're all on the same page, just wanted to make sure that we put that out there. Next slide. So first, we're going to talk about the different types of nonprofit organizations. I understand from the background that Ivy gave us that there may be a lot of different structures that you're looking at, and that you're coming to the table, coming from different structures. Some of you may be with 501c3s, 501c4s, 501c6s, for-profit corporations, universities, any number of different organizations, to try to figure out how to move forward with your activities and your work through the government grant, and also to figure out what's going to be an appropriate funding source if you expand beyond government grants, if you go to the private sector and are looking at getting funding from other avenues. That may impact how you decide to organize yourself, and so we'll talk a little bit about that as we go through. Next slide. So the first thing we're going to talk about are 501c3s. These are charitable nonprofit organizations per the IRS. The 501c3 is the section of the code in the Internal Revenue Code that refers to these organizations. 501c3s have a charitable purpose. They have to operate exclusively for religious, charitable, scientific, public safety, literary, or educational purposes. And the earnings for all nonprofit organizations, the earnings of the organization cannot inure to the benefit of any individual or individuals. So it has to be, for the public good, for charitable purposes, and for C6s, we'll talk about for business purposes. 501c3s can engage in an insubstantial amount of lobbying. And depending on the size of the organization, that insubstantial amount of lobbying may change. If you are an organization that operates basically at sort of below $1 million a year, you can basically spend up to 20% of your funds on lobbying. The larger you get, the smaller that proportion gets. And so, that is something to consider. If you do feel like you have a need to engage in substantial lobbying activity, then a 501c3 is probably not going to be the vehicle to get you there. You can engage in issue advocacy and educational campaigns. Those are not, that fall short of lobbying. As a 501c3, that you can engage in an unlimited amount. And you can only engage in nonpartisan voter education, get out the vote, and voter registration. Now, I don't foresee that is going to be a big push for the organizations that are on this call, but just to be mindful that a 501c3 cannot engage in any partisan political activities whatsoever. So anything that you would do, you can engage in some voter registration, voter ID, but it has to be nonpartisan. Next slide. In terms of the 501c3s, on the receipt side, they can receive unlimited donations from corporations, individuals, other nonprofit organizations, universities, pretty much anyone, even from foreign sources, although that has to be disclosed on the annual 990. But the receipt side is unlimited. The donors are disclosed to the IRS. But anyone who contributes more than $5,000 is disclosed to the IRS, but that's not required to be publicly disclosed. Contributions are tax deductible as charitable contributions to a 501c3. So if you've got donors that care about that, I mean, for government grants, that doesn't really matter. But if you are looking at private donations from corporations or from individuals, they may care about the tax status. They may care about getting that charitable deduction. And so you may find that it's easier to operate as a 501c3, easier to get private funds and fundraising if you're a C3 versus a C4 or a C6. In terms of the disbursements, you can make direct programmatic expenditures or grants to other organizations, so long as it adheres to the 501c3 uses of the funds. So you cannot you can't basically donate as a 501c3 to another organization that's going to engage in lobbying in order to get around that lobbying rule. So if you're donating to an organization, that same percentage attaches to that donation, and basically would be considered sort of your lobbying activity. So you at all times, your 501c3 funds, because you have gained the benefit of having tax deductibility with respect to those funds, you have the burden of only being able to spend them for those 501c3 charitable purposes. If you are in a position where you're granting out as part of your mission, you're providing grants or loans or other funding to organizations, it's important to have in place systems to monitor the use of those funds so that they are you can be assured, and you can assure the IRS that any funds that the C3 is granting out are used for 501c3 purposes. And then, of course, for operations purposes, anything that aligns with the organization's mission, you can spend your funds on. Reporting for 501c3s, you do have to file an annual 990 form with the IRS. That is a fairly detailed, it's fairly long report that details the receipts and disbursements, includes essentially a balance sheet in there, and then a lot of other information about the organization's activities. Some states require additional reporting. So some states, would have an annual report or a biennial report that you would have to file in addition to the 990 with the state. And many states require charitable solicitation, registration, and reporting. So if you are soliciting funds, I think it's in 39 states and DC. If you're soliciting funds in those states, and there are specific parameters around what that looks like, but in general, if you're soliciting the public for funds or soliciting other organizations for funds, you would have to register with the state for charitable solicitation purposes. Next slide. 501c4s, I think this is probably not going to be a great vehicle for a lot of you, but I will mention it. It's sort of like 501c3 light. You don't get all the benefits of being a 501c3 in terms of not having tax deductibility, but it's a social welfare purpose where you're operating primarily to further the common good and general welfare of the people of the community. I think that does align with a lot of your mission statements, but I think, for many of you, if you're going to fall into the bucket of being either a C3 or a C4, the benefit of having that charitable tax deduction is probably going to outweigh the fact that if you're a C4, you can engage in unlimited lobbying. You don't have that same restriction on the amount of lobbying that you can engage in. You also can engage in unlimited issue advocacy and educational campaigns. You can engage in nonpartisan voter education, get out the vote, and voter registration. That all falls under primary purpose. And you can also engage in political activities. So if political activities, if there is now with a government grant, you can't really use government grant funds, but if, in the future, if you have private funding, and some aspect of your activities, as a strategy, you want to be able to engage in political activities, the C4 is going to be a better vehicle for you than the C3. There is a limit. You can't be your primary purpose. Basically less than half of your expenditures can be for political activities, and there's a safe harbor at 40%. Independent expenditures only at the federal level. C4s can't make direct contributions to candidates at the federal level, but they can in about half of the states. So it just depends on kind of where you're operating and what you want to be doing. Next slide. Financial information is very similar. You can receive unlimited donations from corporations, individuals, and other nonprofits. Donors are generally not disclosed unless you're engaging in independent expenditure, political activities. Contributions are not tax deductible as charitable contributions to a C4. So if you've got private funders or individuals and you're a C4, they cannot take a tax deduction on that. In some limited cases, depending on your activities and who the donor is, it may be tax deductible as a business expense, but not any portion that's used for lobbying or political activities. Disbursements similar to C3s, you can make direct programmatic expenditures, and you can make grants to other organizations that align with the mission, but it's, again, important to make sure that you're monitoring those grants and making sure that the funds are being spent in the way that you intended them to be spent. They do require 990s, just the same as the C3, detailing your receipts and disbursements and other questions, who are your top vendors, who are your top employees. And then some states have additional reporting. Generally, C4s do not have to register for charitable solicitation purposes, although there are a few states that do require C4s to register the same as C3s. Next slide. So C6s is our third bucket of organizations, and these are groups. These are like your trade associations, your business leagues. They are the organizations that are organized with a common business interest purpose. So they operate primarily to further the common business interests of that group. So they're not out to benefit the general public. They're benefiting the common business interests. And if everyone could put their phones on mute, that would be great. And again, here the earnings cannot inure to the benefit of any individuals, even if the benefits of the group the benefits are to the group. C6s can engage in unlimited lobbying. They also can engage in issue advocacy and educational campaigns. They can engage in that nonpartisan voter education activity. Their political activities are the same as C4s. So they are limited. It can't be their primary purpose. And they can engage in independent expenditure activity at all levels and direct contributions to candidates only in certain states. Next slide. Receipts, they can receive unlimited donations from corporations, individuals, other nonprofits, other organizations. C6s are generally membership-based, and so you have a finite group of members, although it's not exclusively a requirement, but generally that's what differentiates a C6 from a C3 or a C4, aside from the other differentiations, is the way that they operate. The donors are not disclosed, again, unless you're engaging in lobbying activity or engaging in political activity. Contributions are not tax deductible as charitable contributions, but they may be deductible as business expenses, and there often is a better case for deducting dues to a 501c6 than there are for the 501c4 as a business expense. Again, you can make your programmatic expenditures, you can make grants to other organizations. You have to file a 990, and there may be additional state reporting. Next slide. So I'm going to turn it over to Chris now, who's going to tee off with corporate formation.
Thank you. And you can jump to the next slide. So once you've decided, what sort of tax exemption you want to pursue, you need to form an entity. For the most part, and really what I'm going to focus on here are corporations. So most organizations that we work with are formed as state law nonprofit corporations. Most states have a pretty well-developed law that governs sort of, how a charitable corporation, how a nonprofit corporation works. They are the ones that the IRS is the most familiar with when it comes to sort of recognizing exemption, and they're the ones that sort of have been set up over time to best work for organizations today. I did want to quickly mention a couple other ones. At the bottom, there's trusts. I work with trusts a decent amount, but that's really in sort of personal, sort of like high net worth individuals when they're setting up private foundations. It's not, they're not very well adapted. They don't sort of have the governance that a corporation would have. And then I get a lot of questions about LLCs, limited liability companies, because they're used for so much nowadays in the business world. The IRS is still catching up. They haven't quite adapted everything to sort of adjust to the new world of LLCs existing all over the place. There's sometimes when an LLC can be used, but for the most part, where I see LLCs used is when there's already an existing tax-exempt charitable organization and wants to do something else. Sometimes an LLC can help facilitate that. But when you're looking at sort of the baseline 501c3 or 501c6 organization, almost all of those that I work with are nonprofit corporations. So next slide. And so at a baseline, nonprofit corporations are governed by state law. So as I said, every state pretty much has its own statute, and there's a bunch of rules that you have to follow to form under the state law. In pretty much every state, there's a distinction between non-membership corporations and membership corporations. And this is, it's something that I think I've been working with it for years and still get it confused in my head sometimes, but I think the terms in some ways lead to some confusion, because people think about things where it's like you're the member of something like a public radio station or an art museum, and think that, oh, well, yeah, we kind of want our organization to encompass that kind of that sort of idea. That's not really what the distinction between membership corporations and non-membership corporations is. It's really the concept of membership in a nonprofit corporation is essentially like a shareholder in the nonprofit corporation. So you can vest the ultimate power to control the corporation in a few people or a small class of persons who oversee who have sort of the ultimate control before turning over the governance of the corporation to the board. Where it's permitted, a lot of times I see more frequently what non-membership corporations, or what we call, they have a self-perpetuating board of directors. And in that case, somebody forms the corporation as incorporator and then turns over control to a board of directors that just continues to manage and operate the corporation. And if there's a major transaction that's coming up, like a merger transaction or an acquisition or dissolution, which do come up in the nonprofit world, it's the board of directors that has the ultimate say. They don't have to go back to some member class or some sort of people who reserve those powers to do that. Whereas that type of transaction in a member organization, does require that additional approval. Next slide. So the way that everything gets up and running, this is where, for the most part, where the lawyers get involved is, you actually go to the state and you form a corporation, and then you start to implement a bunch of policies and procedures. The first step is filing articles of incorporation with the state where you want to incorporate. For the most part, like I said, there's states that we have preference for over others for various reasons, but a lot of times it ultimately comes down to where is sort of the nerve center of the organization going to be located. And for the most part, if you're really going to be there and if you're going to have a physical presence, you're going to have to deal with registration in the state anyway. So that is sort of the default where you'd want to form. But if you're in multiple states, then maybe you take a look at the various laws and decide which one's the most preferable. When you go, you file the articles of incorporation. It's a pretty basic document, but state law will require some provision, some information. For example, in Pennsylvania, where I'm sitting, it's really basic. You don't have to give any kind of information about the people who are going to be on the board of directors. But in a lot of states like New York, you have to set forth the initial board of directors as part of that initial filing. A big issue, and this is why we sort of get involved from the beginning, is that the articles of incorporation have to have what I call the IRS magic words, and it kind of depends on which exemption you're going to be pursuing. If you're a C3, there are specific provisions that need to be in the articles of incorporation that the IRS will look to see are there, and they deal with the limiting of the purposes to charitable purposes. And then a big one is dissolution, is that charitable organizations have to essentially dedicate their assets to charitable purposes. So when they dissolve and assets get distributed out, they have to go in further into those charitable purposes. So a lot of times articles of incorporation that I draft are 1 page or 1.5 pages, but a big chunk of that is the IRS magic words, is making sure that an organization that wants to be exempt is going to be exempt. The bylaws are a lot more flexible in some ways, in that they don't have to be filed with the state. There are some restrictions under state law as far as what you can and can't do with respect to the governance, but for the most part, there's a lot of freedom. You can decide how many directors you're going to have. You can decide if there's going to be kind of different classes of directors, how the voting is going to work, what's going to happen if a director resigns. You sort of then set forth just sort of the way that meetings are going to work and who's going to have voting rights, and if some people might be on the board but not have voting rights. You can establish the officers. What are you going to have? Like in most states, all that's required is a president, a secretary, and a treasurer. But a lot of times you're going to want to have maybe vice presidents who are in charge of various aspects, maybe have assistant treasurers, assistant secretaries, and things like that. And that's where the bylaws is where those decisions are made. And again, there's a lot of flexibility there, because those are not sort of filed with the state or approved by anyone. They can be changed a lot more freely. So the articles of incorporation are sort of more locked in. You have to go back to the state if you want to make any changes to those, but the bylaws are a little bit more flexible.
Chris,
Yep.
interrupt you for a second. It looks like Dan has a question.
Oh, sure.
Go ahead, Dan.
Yeah, hi, thanks. I was recently just filed a 501c3 application with IRS. I was surprised that they didn't ask for these documents to be attached. Did I miss something, or they want to get them directly from the states?
It depends on, did you file, the 1023 or the 1023 EZ?
The easy.
Okay, so the EZ, they do not actually require them to be attached anymore. We'll talk in 2 slides a little bit more about the 1023 and the 1024, but you did not miss anything if you did the 1023 EZ with that.
Okay, so I assume they're gonna get the documents and review them, or
They
they're just
usually don't
trusting
even
you?
go do that. They usually take
Okay.
you for it and that you certified as part of the process that you had the magic words in there.
Okay, thank you.
Yep.
Thank you.
Sure. So the next slide real fast. In addition to the bylaws, a lot of times we'll have, there'll be other policies that are, some of which are required by state law, some of which are just strongly recommended. The biggest one that comes up is the conflict of interest policy. It's not technically required under IRS rules, but the IRS does want to see one. And if you don't have one in place, they may come back and ask questions. I sometimes just build a conflict of interest policy into my bylaws when I'm doing this, but but it's also very frequently just sort of a standalone document. They're important because I think they're sort of a default thing that anytime you've got a nonprofit organization and there's going to be transactions with related persons, that people want to be very, very careful. And so I think it's important to note that it's like a transaction with a related party is not prohibited, but having a good conflict of interest policy in place is really essential, and then complying with that. And what it usually requires is if the organization wants to hire somebody who's related for some reason, that the terms of that transaction get disclosed to the board fully, and the board has an opportunity to compare that arrangement to other potential arrangements. And then people who are independent, people who don't have any kind of potential financial interest, approve of the transaction. And so a base conflict of interest policy, that's really all it says. But you can build up from that quite a bit, and you can have all kinds of more disclosure requirements. You can have some types of transactions that you, the organization, just decide to prohibit for whatever reason, but that's kind of the baseline for it. Other policies that we frequently draft as part of the formation are an investment policy, whistleblower policy, compensation policy, record retention policy. Again, some states, New York has some really strict requirements about if you file under New York law, you have to have an investment policy, and a couple others. For the most part, they're not technically required. So it sort of depends on the actual operations, what you think makes the most sense, but they're pretty good. Best practices would dictate that you're going to want to have some kind of policies that dictate those issues. Next slide. And so this goes to what Dan's question was, is that there are 2 ways that you get into the IRS as a tax-exempt organization, sort of at the big picture. The first is the 1023, which is used by 501c3 organizations. There is now in place what's called the 1023 EZ, which are smaller organizations, generally organizations that are going to have $50,000 a year or less of annual receipts from all sources, can do the 1023 EZ. But the 1023 it's a pretty big document when you look at it. I mean, I think if you just print up the application from the IRS website, it is like 40 pages long. And under current rules, there's no mail-in process. It all has to be completed through the IRS's website. The 1023, the full 1023, it requires you to sort of come up with a budget for, like if you were forming today, you'd come up with a budget for 2023 and then 24 and 25, and a narrative description of the activities that's sort of broken down as far as telling the IRS, this is what we think we're going to really do on a day-to-day basis, the varying percentages of those activities, and then explaining to the IRS why those activities are charitable in nature. It sort of convincing the IRS that, yes, that, Kate gave the definition earlier, that this organization is going to do things that are dedicated to benefiting the public, truly charitable, and defined. Yes. Sorry, I got a question in the chat there that I will do as far as the related parties. That's a good question. That was back for the last slide on the conflict of interest policy. Really, a related person for these purposes is going to be anybody who's an officer, a director, people who make substantial contributions, and then sort of the family members of those persons, and then people with whom those persons have a business interest. So a really common scenario would be somebody is on the board of directors of a nonprofit corporation, and they have a close family member who is an accountant, for example. Finding somebody who is a good accountant to do tax returns can be very difficult. So maybe they will reach out to that person and want to hire them to be the accountant for the nonprofit organization. And that's again one of those where what you want to do is make sure that the board knows how much it's going to cost, what other similar accountants would charge, and what the relationship is. And then as long as independent people approve of that, it's okay. Conflict of interest policies themselves a lot of times will define who is related for these purposes. There is law on that in the Internal Revenue Code, but a lot of times the policy itself will even sort of expand that to add sort of another gloss of like caution, so that you're kind of saying, well, even if there's not a pure conflict, we want to run this by an independent board anyway. So jumping back, I had one to the 1023. And yes, I saw the question in there. A couple questions. One, we do help with the 1023 all the time. That's one of the things that we spend a lot of time working with our clients doing, is helping to draft the narrative and helping to look over the budget, look over the yes or no questions, and help sort of tailor that before submitting it. And the other question is, and the idea of the 1023 easy just came up a couple years ago, and it's, I would say, to put it kindly, it's still a little bit of a work in progress, where technically, if you submit it, so if you run the budget and you think we're going to have $40,000 this year, $45,000 next year, $45,000 the year after that, submit the 1023, and then it turns out that 2 days after submitting the 1023, somebody comes in and gives you a $250,000 grant. There's no process to go amend that, and there's no process really to change the filing. What the rules dictate is that when you click submit, you're making a good faith estimate that you're going to qualify to submit the EZ. Other than that, on a going forward basis, you just have to report your actual activity. So, and there's no penalty for doing it. I've seen quite a few times where organizations have been approved of through the 1023 EZ, and then end up, it turns out that they wouldn't have qualified if they would have known that at the time, but there's no real way of fixing that. All you do is you file your 990 and you file that truthfully going forward. To that point, I tend to err on the side of filing the full 1023. It's like, if I'm working with clients who are, and they're looking at budgets of, $10,000 or $15,000, maybe not, but whenever I get involved with any organization that's bigger, even if I think technically they could qualify, I tend to err on the side of filing the full form. If you are going to get exemption as an organization other than a C3, so if you're going to be a C4 or C6, though you file the form 1024, it's very similar to the 1023, but it is a little bit shorter. The narrative can be a little bit more. It can be a little bit more sort of broad-based. There's not as many specific questions, but it does still have a budget. It does still require sort of an explanation as to why the activity will qualify for under whichever section you're seeking the exemption. Kate mentioned this earlier, but we cannot say it enough times. The 990 has to be filed by every organization that's exempt from tax. There is a really basic filing that can be done for small organizations called the 990N. And then there are larger forms that sort of grow as you get more and more. There's a 990EZ, and then ultimately the full 990. But if you fail to file for 3 tax years, the IRS automatically revokes the tax exempt status. Another question that popped up that I was going to talk about, but I think I get the gist of the question, is when you form as a state law nonprofit corporation, it takes some time sometimes to do the 1023, and then it can take the IRS a really long time to get back to you and actually give a response. As long as you're formed as a nonprofit corporation and you're going to be a 501c3, when you get that determination letter from the IRS, it's retroactive back to the date that the nonprofit corporation was formed with the state. So technically, contributions made in that window are tax deductible to donors, to individuals who are worried about that. As a practical matter, it's a little bit trickier than that, because you sort of have to work, you might have to work with donors to get them comfortable that you're going to qualify. Sometimes we'll work with organizations called fiscal sponsors that sort of help to bridge that gap a little bit, where you can partner with an organization that already has its exemption. But sort of as a pure legal matter, because the determination letter is retroactive, you can really start operating, and you can start taking contributions the moment that those articles are filed with the state. But that's one where I would, talk to an advisor and proceed with a little bit of caution. All right, we can jump forward. And you can go to the next one too. I just wanted to mention a few quick things that are sort of tax-related concerns for nonprofit organizations. A lot of times, like the goal obviously is you get the determination letter and you're tax exempt. Technically, all that means is that the organization is not subject to federal income tax. Other taxes have to be looked at to make sure that there's no issues. I wanted to quickly mention executive compensation only because I get a ton of questions about this. It also goes back to what Kate was talking about avoiding private inurement, avoiding any kind of, avoiding this appearance that somehow a tax exempt organization or a nonprofit is really benefiting, a board member or its executives or anything like that. Nonprofits, tax exempt organizations are free to pay contractors. They're free to pay employees. They're free to pay their executives, and they're allowed to do so reasonably. But we recommend sort of at the beginning getting sort of checks and balances into place to make sure that the compensation that's paid to executives is reasonable. The IRS has procedures in place. There's rules that are called intermediate sanctions, where they can swoop in and they can try to impose penalties in situations where these rules are violated. And it's kind of it's a stop short of trying to revoke tax exempt status, but they can invoke penalties, and they can invoke penalties even on board members in some situations and on the people who are affected. So to avoid that, we recommend getting a compensation policy in place from the beginning. And what is recommended with that is that you go and you get a survey of other similar organizations, what people in similar positions are paid. Use that to establish like a fair market value. And then you review that, you approve that, and keep those records. And that goes a long way towards trying to avoid any of these possible challenges. Next slide. Did want to mention what's called unrelated business taxable income. So 501c3 and 501c6 are exempt from most sources of income, but you can be subject to tax if you engage in what's called an unrelated business, and if you generate unrelated business taxable income. It's really exactly what the name sounds. If you're engaging in a kind of business activity that's not directly related to the tax exempt purpose of the organization, the organization can be subject to tax at the corporate tax rates. It's basically just treated like a corporation for the purposes of that limited income. You can jump to the next slide actually too. And so what UBTI is it's really any income from a business activity that's regularly carried on and that's unrelated to the exempt functions of the organization. One big thing to keep in mind about this, and a question that I get a lot, is even if you take all the net profits from an activity and put them back into the charitable purposes of the organization or the exempt purposes of the organization, that's not enough to change the character of it. It really does sort of take, like, the analysis is essentially like, are you competing with a for-profit business that might be doing the same activity? Another way that the UBT issues come up is when there's an underlying investment that may throw off income that otherwise would be exempt, but the organization borrows money to do that. And that's what's called unrelated debt financed income. And that's, again, it's a complicated concept, and it's one to just sort of be aware of, is that tax exempt organizations can borrow money just as a business can, and they can sort of work within that, but it could have consequences. All right, next slide. And then finally, like I said, is that the getting a determination letter from the IRS says that you're exempt from federal income tax as long as you keep filing your annual 990. But it doesn't necessarily apply to all other types of taxes. Big ones that we come across are sort of employment taxes and payroll taxes. Exempt organizations are subject to those just as any other employer would be. You have to worry about filing returns, you have to worry about withholding, and worry about paying. Sales and use tax is another big one. In a lot of states, 501c3s but not other exempt organizations can go apply to be exempt from sales and use tax on purchases that they make. But there's no state that I'm aware of that exempts a 501c3 from collecting sales or use tax if it's engaged in transactions that generate those. And with respect to both employment taxes and payroll taxes and sales and use taxes, there's some situations where responsible persons, where the people who are actually in charge of, cutting the checks, can be held personally responsible for those taxes. Because when you're in that position, when you're selling taxable goods or services, or when you're paying employees who are subject to employment taxes, they're what's called trust fund taxes. You're actually acting in in the sort of a capacity as a trust fund manager for the state that you're in or the local jurisdiction that you're in, and supposed to collect those and turn them over to them. So again, this is like, a big sort of picture way of saying that once the determination letter comes and you're exempt from federal income tax, it's still worth scoping everything else. This doesn't even go to some other concerns that could pop up, like if you own real property, you may or may not be in a position where you can go apply to get a property tax exemption for that. The state law in every jurisdiction is going to differ on that, and then the process of going to get an exemption is going to differ. So again, this is where it's worth talking to good advisors and making sure that you have a good scope of all those potential issues. All right, Kate, do you want to quickly mention the audit requirements and then we'll wrap up?
Yep. So next slide, please. So there are federal audit requirements and then some state audit requirements. The federal audit requirement falls under, and this is for any sort of federal grants or any federal funding, including the awards that your organizations have received. It falls under the Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards, so commonly referred to as the Uniform Guidance. And under this, expenditures of federal awards funds of over $750,000 in a fiscal year triggers what's called the single audit or a program specific audit. And the thing here to remember, it's not sort of when you get the award or how much the award was, it's that you're spending $750,000 of that award in a fiscal year that's going to trigger the audit. So, if you receive a grant in year one and don't expend any funds, you would not trigger this. But if in years 2 through 20 you're spending down the funds and you're spending more than $750,000 a year in those years of the federal funding, then you would trigger this audit requirement. The single audit and the program specific audits are much more detailed even than an independent audit would be. They're done by independent auditors, but there are very specific requirements that the government has. It's both a financial audit and a programmatic audit. So they're looking on the financial side to make sure, are your numbers right? Does everything look like it aligns? But also, have you complied with the general accounting principles? Do you have sufficient internal controls? Have you followed any statutes, regulations, the requirements of the award? It really looks at kind of everything from a compliance side to make sure that that you've appropriately spent and used the funds. Once you've triggered the audit requirement in any fiscal year, you have to submit it. You have to, find somebody to do this audit, and there are a lot of auditing firms, accounting firms that do this. But I will tell you that accounting firms are up to their eyeballs and there's not enough of them and there's not enough good ones for sure. So don't wait. Make sure that, if you think you're going to have one of these audits, that you're proactive and start early and find an auditor and work with that auditor, basically from the beginning of your fiscal year through the fiscal year, to make sure that you're collecting all the documentation you need and gathering everything together, because this is a substantial resource allocation that you're going to need to do. Once your fiscal year ends, you have to complete and submit the audit report to the Federal Audit Clearinghouse within 9 months of the end of your fiscal year. And if the report is due earlier, is done earlier than that, you have to submit it to this clearinghouse within 30 days of when the auditors complete it. So there are fairly tight timelines, and like I said, auditors are in high demand. And it's, you know, it can be very difficult to find an auditor that has enough capacity, particularly for a large organization that has expended significant federal funds. Next slide. There are also some state audit requirements. Some states do have laws that require nonprofits that are registered in state to perform audits. And it could be based on specific, you know, similar to the federal, that you only trigger this requirement if you spend $500,000 or $1 million or, you know, some other set amount. And then some states, you know, have an audit requirement for, you know, any organization that's, you know, registered under their charitable solicitation rules. So, you know, that's another trigger for an audit requirement. And then many states require 501c3s to submit copies of audited financial statements. So even if you don't have a specific state audit requirement, there's not parameters around it. It will say that, you know, in order to be eligible to register for charitable solicitation, you have to submit copies of your audited financial statements from an independent auditor. And as I mentioned earlier, there are 39 states and DC that require charitable registration in order to fundraise in those states. Now, that fundraising, you know, it's in some states, it's kind of more of a blanket requirement. In other states, it depends on the type of fundraising that you're doing. Are you doing sort of mass solicitations to the general public? Well, that's going to trigger registration, whereas just sort of one-on-one with private donors, where you're not kind of publicly, in some states would not. In other states, it would require registration. So it really just depends. Next slide. And that's the end of our presentation. If anyone has any questions, and maybe actually our contact info is at the end of the end of the presentation. So maybe Pearl, if you could just flash that back up there so people can jot that down. But yeah, if anyone has any questions, we're happy to chat. You don't have to put them in the chat. You can just come off mute.